Guy, and again, we're seeing pushback from Fed officials like Mester even now, but where are you? You think March or no?
I find it pretty unlikely, right? As Steve and as Rick mentioned a moment ago, there's a pretty high probability of a March rate cut priced in, but I like to think about that probability more as a small probability of something large and somewhat random going wrong, and a high probability of nothing happening. We've heard comments from several Fed officials over the course of the last week or 2 weeks highlighting the idea that it's just too soon to be confident. It's time to ease off their relatively restrictive level of interest rates. And frankly, at this point, just about 2 months before the March meeting, we would already have to be paving the way based on the Fed's forward guidance approaches over the last couple of years. I
totally agree. And Guy,
so I think it's unlikely.
I also wonder if the more significant data point this morning wasn't, CPI, sure, but it was kind of, a non-event, was actually jobless claims. They were still so strong. I mean, if the Fed wants to push back on a cut, they only have to point to the still strong economy. If claims were already moving higher, I think the market would be very much pushing back against this.
Yeah, which is fair. At the same time, it's still a holiday period when it comes to the jobless data, and those weekly numbers are pretty noisy. So I don't think we've got, Jay Powell and his colleagues staring at that data point come 8:30 every Thursday morning. At the same time, there is a lot of evidence that labor markets perhaps are easing off the gas pedal a little bit, but are still relatively strong. We're seeing decent job growth. There's no evidence of economic deterioration, certainly not any material way.
Michael, where are you? What should investors do? Do they buy bonds here? Is this their last chance, or are we going to be surprised by rates moving higher again in general?
Kelly, I'm not sure rates really move higher. I've been in the camp that you're not going to see a rate cut until probably the summer, unless something really, really bad happens. The economy is not in that bad shape, and certainly labor indicates that it's not in that bad shape either. So I look at it as a scenario, yeah, I think you can extend your durations a bit here. I don't think it's that you have to go run and do it today, but I think you're going to want to move some of that cash to slightly longer durations. I don't think rates go up a lot, but I also am a believer that I don't think inflation drops a whole lot here either. And that's what I think keeps the Fed on the sidelines longer than a lot of the market expects.
A lot of people are almost saying the opposite, Michael, where they say, well, you got to be careful going long duration now because we've got, kind of the deficit debt situation to kind of still get through, and the short term looks more secure because we can kind of figure out the Fed's trajectory. Why not go with that consensus?
Well, and I said longer duration, meaning, everyone's in cash now or 3-month T-bills.
Got it.
I think you can go out 3, 4, 5, 6 years. I don't necessarily know if I want to have a lot of money out at the end of the curve, like the TLT, something like that. But I think you could start to look at kind of where the ag is and start to move some of your money out there, given the fact that at some point rates do come down. But again, I don't think it happens right away because I think the Fed's going to be on hold. I think Powell's a student of history, remembers that the Fed back in the 80s wasn't aggressive enough as it needed to be on inflation. Then we had a big inflation problem after. So I think if anything, they're going to wait until they see some real data that inflation's been beaten and maybe there's some deterioration in the economy for a rationale to really cut rates.